Hey, wanted to do a little bit of a change of pace on what we normally do with this video. Wanted to take a moment to provide some context on the whirlwind that's been the investment markets over the last 3 months and really dissect what happened. So before diving in, though, it's worth expressing that to understand why markets do anything with certainty is to understand the buy-sell rationale of millions of people on a minute-by-minute basis. So in other words, it's really impossible to understand exactly why the markets do what they do. But with that said, we certainly experienced some of the fastest moving markets that we've ever seen over the last few months, and that obviously has come in the wake of all of the uncertainty that COVID-19 and the global pandemic outbreak has created. So, I mean, to give you an example, from March 9th to March 18th, right in the heat of that moment, we had 8 consecutive market days of 5% or greater swings. That is not something that we have seen before. We obviously reached a conclusion of the longest bull market in history, an 11-year bull market. And again, all of this surrounded just the amount of uncertainty that we were embracing at that time. And a good rule of thumb is that markets hate uncertainty even more than it hates bad news. So we certainly had our full share, our fair share of uncertainty. At the end of the day, markets raced down from about 30 to 35% at the trough. So now that I've invoked some PTSD in all of you, let's try and dissect kind of what happened. So really, I break it down into 4 interrelated things. The first thing is the obvious one, the COVID-19 outbreak and the economic implications of it. The second one, though, is that underneath that all, somewhat connected, was an oil war between Russia and Saudi Arabia particularly that collapsed oil markets. Third, we had a primary season of a presidential election year, which typically in and of itself brings some volatility to markets. And fourth, we had a very strong 2019, so some valuations may have been looked at as maybe a little bit frothy to begin with. Now, what do we think has stabilized it? We can't know for certain, but we acknowledge when we're looking for a place to assign credit to the recovery that we've experienced over the last couple of months, many people start with the Federal Reserve. They really took unprecedented action, not just with interest rate policy, but actually going as far as buying ETFs themselves. And that has really created some stability in global markets. In addition to that, obviously, massive stimulus was passed, about $2 trillion and more expected. Just to give you context, in 2008, the TARP stimulus package that was passed was a little less than $500 billion. So a lot of money has been injected to the system to provide stability, and as such, the market has seemed to regain its footing a little bit. And of course, the question that many are asking is it over yet? And really, who knows, right? There's not a really way to know, and it's not very difficult to see various headwinds when one looks at the current U.S. economic position. So it's easy to feel like maybe there's still some bumpy days ahead. It's important to remember, though, that the market does not walk in lockstep with economic reality and economic conditions. To give you an example, since 1948, if we looked at U.S. markets relative to unemployment, U.S. markets actually are up just 1.7% on an annualized basis when unemployment is 4.3% or lower. Compare that to when unemployment is 6% or greater, the markets are actually up 13.7% on an annualized basis. So the markets have done better historically during higher unemployment levels, and that's because it is not matched up perfectly with what economic conditions are. It's a forward-looking indicator, and I like to reference the great Wayne Gretzky, who used to say that I skate to where the puck is going to be, not where it's been. That's a fitting encapsulation for what the market's intent is. I hope this has helped you unpack a little bit the wild ride we've been on. It's my opinion that the ride is worth the bouts of dizziness here and there that we tend to have from time to time, particularly for those who have a well-conceived investment strategy and those who remain committed to that strategy amidst the bumps in the road. And to have a strategy that's aligned with your specific circumstances.
The Cautious Investor with Jonathan Lapine is sponsored by W3 Wealth Management.